Just curious, the extent to which, sort of COVID disruption has changed the way you think about, onboarding new investment relationships, whether that's, manager driven or elsewhere. Has that changed? Are you still relying on advisors? Are you doing that, kind of due diligence yourself? Are you just kind of going with the relationships where you already have? Are you expanding that right now? What does that look like?
Yeah. Well, I will say this. First, I want to say that, having a great chief operating officer was really, really a wonderful thing. And then when this all hit, because we were able to kind of just port our business. The other thing I'll say is I never thought I would say living and working in Rochester, New York would be an advantage, but we actually just opened our office again in upstate New York. So I would say that, and I do think it is an advantage. I kind of joke about it, but being out of the, having clients in New York City and on the coast and everything, but having kind of this Rochester, New York perspective is somewhat helpful as a side note. We do divide and conquer, as Carl said. I said we were meeting daily. We're no longer meeting daily, although we have some kind of investment committee meeting daily. So we have a traditional committee, an alternatives committee, and then an asset allocation committee, and then our full investment committee where everything kind of comes together. We've been doing a lot. I would say, at least the way I feel right now, is that we've been a lot more productive in terms of our manager calls and investment manager meetings. We're getting access to the people that are running the portfolio easier. And it's been, because people aren't traveling, it's actually helped us in our due diligence efforts and our overall research efforts. We are also meeting with new managers and moving some things forward. And a lot of those relationships come from existing relationships. So I said earlier that we have professional investor clients. A lot of those introductions come from those folks, which is pretty invaluable when we're considering making a new investment. We're making a couple new investments with firms that we've known for a long time, but haven't invested with them in the last several years, especially in distress, because there hasn't been a lot to do. So I guess, like Paul said, some of this is unknown, but I would say, first of all, I'm thankful that we had the leadership and I was totally not involved. I'm not the person to be in charge of any of this, but the leadership to take our business to the cloud, so to speak, and then the structure around the investment committee and the divide and conquer around investment managers, the access to principals of firms, which is always key to us. But when you can get on a Zoom call and talk through things, it's pretty productive. And we'll see, kind of what the future holds, but we're looking at new managers and we're moving due diligence along.
Private credit, you mentioned private credit, distressed, maybe that sort of falls into the purview of your kind of alternatives investment committee and the work that you did there. Maybe just kind of curious generally how much alternatives feature, I presume a fairly, kind of notable allocation, thinking about your client base. Just curious, maybe kind of high level, are those allocations to sort of kind of non-traditional asset classes, growing, and maybe a little bit on sort of where you're spotting opportunities and how you view the private credit or distress space right now?
Yeah, I think, in talking with us, we've always had a pretty prominent allocation to what people consider to be alternatives now. So I consider alternatives anything that is skill-based with a differentiated source of return. And it could be a private structure, it could be a hedge fund structure, it could be any kind of legal structure. But when I think of alternatives, what I think you're trying to do is diversify risks, enhance returns, do something, as Paul said earlier, something uncorrelated. So I would say skill-based equity in a hedge fund structure has a more prominent role right now, because many of, and this doesn't necessarily apply to large pension funds, but in our world, some of the best skilled managers are set up in hedge fund structures and their own capital is invested alongside ours. And I think, as I said earlier, that skill and understanding balance sheets and understanding who can live with 6 months of no income? What kinds of companies? What's permanent impairment versus not? Who's going to have a leadership position coming out of this because the competitors will be gone, or some of them? All of those. What's the regulatory landscape? All of those things, to me, fall under the purview of active management, and in some cases alternatives like hedge fund structures, because they may be small to mid-cap managers with limited capacity in an incentivized structure. Is that alternative? Yeah, I guess. We have always had a significant investment in private equity and secondaries, in secondary real estate. That's going to be very interesting, I think, in the next couple of years, the secondary market. And I think, the not so short answer is skilled equity that does fall in the alternative category because it's probably small to mid cap. Hedge fund, yes. Private equity, secondaries, yes. Someone said earlier on the earlier call, as long as we're pretty darn convinced we're getting a premium, which we have to be to lock up our capital, we're going to do more of that. Private credit, we've spent a ton of time there. I feel like we've talked with everyone who's got raising a fund, and there's a lot of people out there that are, same old names and a lot of new ones. And we just today released a white paper on it, which I'm happy to share. But yeah, I mean, we've always, I started, in 1987. So in 1993, I was doing what were called alternative investments, and that was basically convertible arbitrage. That was the only alternative investment that I remember. But we started doing this a long time ago, but it was always with the same goal. How do we provide consistent returns? More consistent returns? How do we put in uncorrelated sources of return, build a better mousetrap? It's always that kind of thinking that leads us to what we could characterize as alternatives. So more now than ever, because it's very complicated.
Yeah, makes sense. Yeah, and good points there. Thank you for that, Lori. Is ESG, another investment strategy? Is it sort of return first? Is it do well, do good? Is there pressure sort of building, mounting, growing for these types of strategies? Just curious, kind of your perspective on the space.
Well, it's interesting because, having been an investor for a long time in the not-for-profit world, endowment, foundation, they tend to lead a lot of the thinking. And it's been an evolution, but I would say that our client base buys into the fact that ESG factors, embracing those, typically you're not sacrificing return by doing that. And in fact, there's a growing body of evidence that, companies themselves do better when they embrace things like diversity, and ESG-like factors. So I don't think that ESG has to exist in a parallel universe. And one of the things I would give a shout out to the firm Angeles, who I consider to be a great peer firm, to look at what they're doing when we're kind of trying to refine our investment process and due diligence. And one of the things that they started to do is to ask every manager kind of these questions regarding things like diversity and firm sustainability, et cetera, et cetera, et cetera. And what we found, and they kind of taught me this, is that most firms will answer those questions, embrace them, and realize to be a better firm, they have to do better on all of these things. So as part of the due diligence process of it's not a siloed approach in my mind. I think it's just part of our due diligence process. The investment has to stand on its own merit, and part of the qualitative work we do has to involve these ESG factors. So I kind of think of it in an integrated way.